It's Soleil, and this is episode 230 of the Orange Pill Investor. And today I want to talk about picking up pennies in front of a steamroller. So that's one fairly common criticism that I hear that people talk about for selling covered calls and cash secured puts. And the steamroller does not exist. It's complete bullshit, and it's a scare tactic. Um, and the reason I say that, as long as you are trading in a cash account or within your margin parameters, then covered calls and cash secured puts are defined risk trades. So they have no more risk than just buying shares in a stock. And in fact, because you have downside protection, it's very small, but you do have some downside protection. Selling selling covered calls and selling cash secured puts will always be safer than just buying the shares. Let's just take a look. If you bought MicroStrategy yesterday or whatever, it was 150. You buy 100 shares, it cost you 15 grand. If you sold the 165 covered calls, that's what, 10% call away value, collected 60 bucks. Now you've reduced your cost basis down to 149.40. So you've added a little bit of downside protection here. What are the potential outcomes? Let's compare scenario A, where someone just holds 100 shares and does nothing, versus someone who holds 100 shares and immediately sells a covered call. Scenario A, the price will either go down, stay the same, or go up. In the case that it goes up, we'll have like a part B, because it can go up but stay below your strike, and it can go up and go above your strike. We'll talk about both of those in scenario B, that is. But in scenario A, you just got shares. So if the price drops to $100 a share, you're screwed. You lost $5,000. Those gains or losses are not realized until you actually, unless you panic sold. You could wait around for God knows how long for the price to come back up. And many long-term investors are perfectly fine with that. That's, and for someone who doesn't want to take an active hand in their investing, that's actually probably a very good strategy. You just buy something you like, and then 10 years later, you check back on your account, and if the stock market continues to do what the stock market usually does, then it'll be worth more later. But scenario A is the price drops to 10 grand, or $100 a share. Compare that to person B, who sold, and it's not a very dramatic example to just collect 60 bucks here, but it really just doesn't matter. Person B sold a covered call, collected some premium. Now their cost basis is lower. So their 100 shares went down to 10,000, but they also have $60 in their account. In addition, so they have $10,062 that they can do whatever the hell they want with. And they haven't lost as much as the person who just bought shares. So it's already a little bit safer than just buying shares, scenario A. Or, the price goes down. The next scenario, the price just trades horizontally. So person A has not lost or won anything. Their account still 15,000. Well, person B has $15,060. So in that sense, the person who sold the covered calls made more profits. What if the price goes up? If the price goes up and stays below 165, then person A who just bought shares, they're happy, their account's worth $16,500, and the person B's account is worth $16,560. So they still did better by selling a covered call. Now, here's the final scenario where the covered call seller will not do as well as person A. And then I'm going to go back to the very first thing that I wanted to talk about so that we can look at this in the proper perspective. Let's say the price goes to 200 a share. Person A is slap happy. Their $15,000 investment is worth 20 grand. And this me, the covered call seller, is crying in their beer because they only made 10% profit plus the $62. So my shares will get called away at 16.5, 165, and I made $1,500 and $1,560. But I still made money. So you can see here that there's no steamroller that exists for the covered call seller that does not exist for just the shares holder. There's capped unlimited upside, but that's not a steamroller. A steamroller means you lose your ass, the company goes bankrupt, and that is not unique to option sellers. If I used to sell covered calls and cash secured puts in this dreadful stock, please do not take this. It's never financial advice, but please do not even put this on your fucking watch list or anything ridiculous. But Nicola was out here. There was some kind of SPAC. I forget what the name of the company was, but there was a merger. The ticker changed. And so I was selling this had to have had a reverse. This damn thing probably had a reverse split. Because when this was happening, I was selling cash secured puts for $30 price, $30 a share price. I don't think it was, I guess it could have been around here. Nah. Yeah, they had to have had a reverse split. I ran the wheel here, made some premium, probably shares got called away, but then as it just starts to suck, the volatility is over and the stock just starts to suck, then I didn't deal. Well, actually, we can look at the freaking history. When was the last time I traded this? Wait, is there history on this thing? The ticker might have changed since they split. All right. So apparently I haven't traded since so long that my history is completely even gone. But the point is I didn't stick to a company that was useless. I didn't just ride this down to zero. But if you had this, it's not like, oh, selling covered calls on this is what caused it to go to zero. If any idiot bought it at this price, regardless of whether they sold covered calls or not, it's still going to hell. So the steamroller is going to affect people who own shares. The steamroller is going to affect people who sell covered calls. But when people say, this is what I think people mean when they say, you're going to get hit by a steamroller. I think they're talking about option buyers, and they just conflate option buyers with sellers. So if you're over here and you're like, I'm going to YOLO 2 DTE long calls, and I'm going to get 10 of these, and I'm going to pay 2,800 because I think that MicroStrategy is going to go to 165 by Friday, and then come Friday the price is at 157 didn't, or whatever, and you paid all this money and your break even is 157 and you lose your whole 2 grand, 3 grand. That's, I think, I don't know if that's considered a straw man, but I think people are thinking about options traders and they hear about all of these long call, short duration, degenerate YOLO bets that go to shit. And then they say, oh, it's all fun and games until the steamroller hits you. But the only thing that the steamroller does is limit upside. It's still a profitable trade. So making 15% returns is not getting run over by a steamroller. That's all I got to say about that. And let's while we're on that topic, let's talk about picking up a few pennies. So I had in this account, I had sold a put credit spread. I had the 125, 124, 125. I had the 125 put and that I sold, and I bought the 124. That was right here. So that was back on 9/16. And then, what is this? 9 days later, results aren't always this good, but 9 days later, I bought it back for half price. So I sold it for 40, bought it back for half price. And as an option seller, you have to think about everything backwards. So a buyer would buy it for 20 and then hope to sell it for 40. So I basically, you could say I doubled my 20 or I collected 50% of what I originally got paid. And to make that 20 bucks, I risked 100. And technically, I only risked 60 because if I lose the 100, I already got paid 40. But let's give it the benefit of the doubt, and let's say that I had $100, a 1 point spread, which is $100, and I ended up with $20 more than I started with. So that's 20%. So made a 20% return in 9 days. That's pretty good. In general, I think the fairly optimistic expectation or reasonable expectation would be to collect that in about 3 weeks. If the price of MicroStrategy had just trended sideways, it would have probably taken 2-3 weeks in order to collect this. So even collecting 20% in 3 weeks is 6 1/3%. Was it 6 2/3%? So that's pretty decent. So maybe you can call that picking up pennies, but eventually this will go against you because here's the chart. So if you sold a put credit spread here, see, 45 days would get you to about May 15th. Yeah. So we've got lower highs here. So if you're selling put credit spreads at the top, which is probably not the greatest idea to do, not selling put credit spreads on green days, that's generally frowned upon. But eventually, if you're mechanically doing this, like if I was to go ahead and replace this with a new one, I don't necessarily know that I want to do that with MicroStrategy trending upwards. Maybe it'll pull back. I don't know. But the most effective time to do this would be on a dip. So anytime you're down here on this dip, then I would probably be selling put credit spreads. And when did I do it? 9/16. So I sold my put credit spread right about here. You could say that it's up from here, but it's also down from here. So I wasn't afraid of this spread at this price. But they're not all going to be winners. That's the point. So I made a 20% return. If I do this trade 10 times, maybe 7 of them are winners and 3 losers, something along those lines. So the winners will eat into your P&L at some point. But if you're smart about not entering these damn things after pumps, then you can improve your chances a little bit. Again, I did this one just for demonstration purposes. I don't really even trade credit spreads that much anymore. But in a small account, like this 5K account challenge that I'm doing, that might be a little bit more effective use of capital to throw in a few spreads. But as a diversification strategy, I would not be doing spreads personally over like 2%, maybe 5% of my total portfolio size. But on a 5K account, what, 10% of 5K is going to be $500. 5% would be $250. Yeah, on a small account like this, 2% would just be setting up like like one point wide spread like I set up. And the reason is because those are all or nothing bets. So I either win the $20 or I lose all of the money. And what I really prefer is owning shares of something so that even if I sell a put here, if I quote unquote lose this trade and CLSK goes down to $9 a share, I get assigned at $9.50. I got paid $27, so my cost basis is $9.23. Technically, I lost $23 on this trade, but I own 100 shares of something. I have a valuable asset that I can now turn around and sell a covered call against and generate more cash. So with owning shares, I like that because I have a valuable asset that other people are willing to speculate on. But just selling a put credit spread is basically saying I'm putting all my chips on the table, and if I win, I collect some of this. If I lose, I take max loss. There's no asset to be had. So the put credit spreads are win or lose. You generally want it better than a coin flip. And if you're using Keller criterion to calculate the likelihood of a profit, that can help as well. But it's still all or nothing bets. And that's why I don't make them a very large part of my portfolio, because if you get unlucky on the short term and you're selling put credit spreads here because you think it's going to 40, and then over time it's down to 8, then you are completely liquidated. Quick note about my switch. So I did go out to 45 days to expiration on a couple of these because CLSK and Riot were both prices were kind of like a dumpster fire. So I did go out to October 18th and sold the $9 strikes just to be able to collect a little bit more call-away value and a little bit more premium in one shot, because I'm going to go out to 1 week on this. 9 days, I mean. You know, going to 850 here, you can only collect $10. And while that's still 1% premium, and I'm totally fine with that, there's a bid-ask spread here. So you're going to get screwed. You're not going to really get a fill at 10. You're going to get a fill at 9. So you're kind of losing $1 there. And then if you want to close it on Friday, you got to pay another $1. So instead of collecting $10, you get screwed on $1 on the way in, you get screwed by $1 on the way out. And so that's already like 20% of this option's value. There's a lot more friction in there. So when a stock is like well under $10 like this, it can be beneficial to go out here and you can get a decent amount of premium at a higher strike. Like if I got assigned at like $11 a share, at least I can go out here and sell this 11. And if the price goes back up to 11, at least I didn't lose money. A lot of people don't like selling calls underneath their cost basis, which I totally understand. And so then in this scenario, I would be looking to manage this trade every 2 to 3 weeks, buy it back for half price, and then sell it out again for full price. So maybe I only collect 14 cents in 2 weeks, which would be 7 a week. But the beauty of that is instead of losing that 20% a week, $1 in and $1 out doing weeklies, I'm only going to get screwed by the bid-ask spread once here. So I could probably get filled at 28, maybe for sure get paid filled at 27. And then I don't have to pay a bid-ask spread next week, or maybe even the next week. It might take 3 weeks before I have to get screwed on a bid-ask spread again. And paying $1 to get in and out of a trade on a $28 contract is a hell of a lot better than paying $1 on the way in and the way out on a $10 contract. So especially on these small accounts, it can pay to do these 45 DTE covered calls instead of weeklies. But, you know, when you're trading MicroStrategy like I am, the little bid-ask spread, you know, really kind of doesn't really matter when you're collecting $500 a pop. You know, $200-300 if you get screwed a little bit on the way in and the way out, it's not 20% of your profits. All right, so we talked about picking up pennies in front of a steamroller, and then we talked about penny pinching on our contracts and the bid-ask spread. So I like the theme for today, and that's it for now. Be good, y'all.